You deposit $10,000 at your bank. The bank smiles, says thank you, and shows you an app with your name and a number on it. Here's what they don't put on the welcome poster. Your money doesn't sit in a vault. Within moments, it's out the back door working. Just not for you. Last year, American banks generated hundreds of billions of dollars in profit, and the raw material for an enormous share of it was money like yours, sitting in checking accounts, earning you basically nothing. In the next few minutes, where your deposit actually goes the moment it leaves your hands, the 4 ways your bank quietly makes money off you, including one with a genuinely scandalous history, and then the exact counter moves, including the 2-account setup that flips the whole machine in your favor and the 15-minute migration plan to get there. By the end, you'll never look at that smiling app the same way. Let's open the back room. Method 1, the big one, is called the spread, and it's the core engine of all banking. The bank pays you a tiny rate to hold your money and lends that same money out at a much higher rate. The gap between those two numbers is their profit. The average traditional checking account pays around 0.0 something percent. Big bank savings accounts often pay under 0.5%. Meanwhile, the bank lends your deposits out as mortgages at 6 or 7%, car loans at 8 or 9, credit cards at 20+. Your money is out there earning strong returns. You're just not the one receiving them. And to be clear, the spread itself is legitimate. It's how banking has worked for centuries, and it funds real services. The scandal isn't that the spread exists. The scandal is the size of your cut, because as you're about to see, banks that pay you 10 times more exist, and your bank is very much hoping you never check. To really get the spread, take the 60-second tour of what happens to your $10,000, because it's genuinely wild that this is never taught. When you deposit, the bank doesn't store your money. It keeps a small cushion on hand and puts the rest to work immediately. A slice becomes part of someone's mortgage. A slice funds a small business loan. A slice becomes someone else's car payment plan. A slice backs a credit card line charging 24%. Your $10,000 is out there in the economy, wearing 5 different jackets, earning interest in every one of them. This is called fractional reserve banking, and it's not a conspiracy. It's the published, regulated design of the entire system. Banks are matchmakers between people with spare money and people who need it, and they keep most of the matchmaking fee. 2 things follow from this tour. First, your money in a bank is not stored. It's lent, which is exactly why the bank can afford to pay you something and why it profits when it pays you almost nothing. Second, the safety question. If the money's out working, what happens if everyone wants theirs back at once? That's what government deposit insurance exists for. In the U.S., FDIC coverage protects up to $250,000 per depositor per bank, even if the bank itself collapses, which means the game isn't about finding a safe bank. They're equally insured. It's about finding one that gives you a fair share of what your money earns. Hold that thought. Method 2, fees, and not as an accident, but as architecture. Monthly maintenance fees for the privilege of them holding your raw material. Overdraft fees that historically ran around $30 per slip. Out-of-network ATM fees, where both machines charge you. In total, account fees quietly pull billions from customers every year. Here's the part that should genuinely make you angry. Fees hit hardest at the bottom. The maintenance fee waives if you keep a few thousand in balance, meaning the fee applies precisely to the people who can't. Overdrafts cluster on accounts that run near zero. The poorer the account, the more it pays. It is a reverse Robin Hood, automated. Every one of these fees has a competitor charging zero for the same service, which means every fee you pay is less a cost, and more a quiz about whether you've been paying attention. Stick around. The answer key is coming. Let me tell you one story from fee history, because nothing teaches you how this business thinks like the overdraft playbook. For years, some major banks processed each day's transactions not in the order they happened, but from largest to smallest. Why would order matter? Watch. You have $90 in your account. You buy 4 small things through the day: coffee, lunch, gas, groceries. Then one big $80 bill hits at night. Processed in real order, only the last item overdrafts. One fee. Processed biggest first, the $80 lands first, drains the account, and now all 4 small purchases bounce. 4 fees. Same purchases, same money, quadruple the penalty by design. That $4 coffee effectively cost $39. Class action lawsuits eventually force settlements worth hundreds of millions, and regulators have since squeezed the worst of it. Many banks have cut or dropped overdraft fees entirely. So why tell you a story about a mostly fixed scandal? Because the mindset that engineered it wasn't fixed. It just moved to subtler products. Every convenient feature your bank offers deserves the transaction ordering question. Who does this convenience actually serve? Turn off overdraft coverage. A declined card costs nothing and 1 moment of mild embarrassment. And never assume the default settings of any financial product were chosen with your interests in mind. They were chosen by the people who profit from them. Method 3 is the one almost nobody knows about: Interchange. Every time you swipe or tap your card, the merchant pays a processing fee, typically 1 to 3%, and a slice flows back to the bank that issued your card. Pennies per coffee. But multiply pennies by billions of transactions and interchange is a multi-billion-dollar river. This, by the way, is exactly where your free cashback rewards come from. The bank shares a sliver of the river to keep you swiping their card instead of someone else's. And merchants don't eat that fee. They bake it into prices for everyone. There's no moral panic needed here. It's simply how the plumbing works. But you should know your role in the machine. Every tap, you're generating revenue. The only question is whether you're claiming your rebate. More on that in the action steps. Method 4 is the most profitable of all, and it isn't printed in any fee schedule: your inertia. Banks know switching feels like a hassle. They know most people open an account as a teenager, usually wherever their parents banked, and never, ever leave. That loyalty has a price tag. Money parked in a near-zero account isn't just earning nothing. It's losing to inflation every single year while the bank earns the full spread on it. Economists have a name for what you're losing: opportunity cost. On $10,000, the gap between a big bank account and a high-yield one has recently been several $100s per year, every year. For doing nothing literally differently, your bank's most valuable asset isn't in the vault. You assume that this is all normal, so let's break that assumption. Here's the counterattack. Move 1. Relocate your savings to a high-yield account. Online banks, with no branch costs, have recently paid around 4% on savings versus a fraction of a percent at the big names. Same government deposit insurance up to $250,000. Same access to your money. The only difference is the size of your cut of the spread. This takes 15 minutes and is worth hundreds of dollars a year. It's the highest paid quarter hour of your life. Move 2. Refuse every fee. 0 monthly maintenance, 0 minimums, 0 overdraft. Accounts with all 3 exist at reputable institutions right now. If your bank charges maintenance fees in this decade, that's not a bank. That's a subscription to nothing. And after the story you just heard, overdraft protection should already be off. Move 3. Claim your side of the interchange river. If, and only if, you pay in full every month, a cashback card converts the checkout machine from Method 3 into a 1 to 2% rebate on your entire life. But hear the warning: carry a balance even occasionally, and interest wipes out years of rewards. The card is a tool exactly as long as the bank earns interchange and never interest. The moment you revolve, you've switched teams. Move 4. The annual rate audit. Once a year, pick a date, set the reminder, spend 20 minutes checking: what's my savings rate, what fees did I pay, what's the best available now. Banks count on you never doing this. Rates change, promotions expire, loyalty is charged for. 20 minutes a year keeps you permanently on the winning side of the inertia tax. So, where should your money live? 3 options, honestly compared, then the setup that takes the best of each. Big national banks, unbeatable branch access and slick apps, worst rates, and most fee traps. Credit unions, member-owned nonprofits, so the spread gets returned to you as better rates and fewer fees. The trade-off is smaller networks and sometimes dated technology. Online banks, no branches means no branch costs, which is why they pay the highest savings rates and charge the fewest fees. The trade-off is nobody to visit and cash deposits can be awkward. None of these is the answer, because the actual answer is stop looking for one perfect bank. Use the 2-account setup instead. Account 1, a zero-fee checking account, big bank or credit union, whichever suits your life, holding only about 1 month of spending. That's your operations hub. Paycheck lands, bills leave. Account 2, a high-yield online savings account holding your emergency fund and every dollar beyond the hub. Earning that 4-ish%? Linked to the hub with automatic transfers, exactly the machine we built in week 1. Migration is 15 minutes of opening the account and 1 payday of redirecting the transfer. You keep the convenience. They lose the spread. Checkmate. Now, the honest reframe, because this channel deals in math, not conspiracy. Banks aren't evil, they're machines. Machines that respond to exactly 1 input, whether you're paying attention. For inattentive customers, the machine runs in extraction mode, near zero interest, fee tripwires, rewards funded by other people. For attentive customers, the same machine runs in reverse, 4% on savings, 0 fees, 1 to 2% back on all spending, deposit insurance protecting every dollar. Banking is one of the only games where reading the rules literally flips which side of the table you're on. The whole system, from day 1 of this series until now, keeps teaching the same lesson. The money world has a default setting, and the default setting is expensive. Every setting can be changed. Most people never open the menu. Now that we've spent 10 minutes on how banks extract, fairness demands the other list. What banks are genuinely good for, because the wealthy don't boycott banks. They use them precisely for the 5 things banks actually do well. 1. Fraud protection. When a scammer hits your credit card, the bank's money is on the line, not yours. That's federal law plus bank policy. And it's why the wealthy run purchases through cards rather than debit. A compromised debit card is your missing money while the investigation crawls. A compromised credit card is the bank's problem. 2. The credit history ladder. Your mortgage rate in 5 years is being written by your payment behavior today. And a long, boring, perfect history with a bank is worth real basis points when the big borrowing moments arrive. That full percentage point on a mortgage is worth tens of thousands. 3. The borrowing relationship itself. For the biggest wealth moves ordinary people make, a home, sometimes a business, a bank is the counterparty, and showing up as a known customer with organized accounts and a clean history gets you taken seriously. 4. Insured, boring safety for your operating cash. We spent all video moving your savings to high yield, but your monthly operating money belongs somewhere with instant access, solid apps, and that FDIC umbrella. That's a bank doing its actual job. And 5. Friction, weirdly. A slight delay between your money and your impulses. The 2-account setup exploits this deliberately. Your spending account holds 1 month. Getting at the real money takes a transfer and a day. That day has saved more people from midnight purchases than every budgeting app combined. So the mature relationship, banks as tools, never as advisors, never as default resting places for wealth. Use the shield, climb the ladder, keep the operating cash insured, and the real money working elsewhere. That's not cynicism. That's exactly how the bank itself would play it. The 4 methods, the spread, now you know exactly where your deposit goes and whose cut is whose. The fee tripwires and the overdraft story that shows the mindset behind them. The interchange river and the inertia tax. The counters, high yield savings, zero fee everything. Rewards paid in full. The 20-minute annual audit, all running on the 2-account setup. Do it this week and you've likely given yourself a permanent tax-free raise of several $100s a year. That closes out the first week of this channel, and if you've watched all 5 videos, you now understand your habits, the averages, the creep, the purchases, and the banks better than the vast majority of people ever will. So here's the final question of the week. What if you had none of it? No savings, no assets, starting from absolute zero at 30 years old? Tomorrow, I lay out the exact step-by-step comeback plan, what I'd do in the first week, the first month, and the first year. It might be the most requested video topic in all of personal finance. Subscribe, and I'll see you at rock bottom. It's where the best stories start.